Many Americans are concerned about financial downturns and possibly a future recession. It might be tough to make sense of such a flood of bad news in these uncertain times. Why would there be a recession? Isn't inflation meant to be temporary? If you're still confused about the rising interest rates and all the gossip about the interest rate triggering the recession, then you need to watch this video till the end. Hey guys, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge for a wealthy lifestyle. Many financial terms, or actually phenomena, are interconnected, and you actually need to know what effect one has on another to make good financial decisions. So, in today's episode, we're going to learn how does interest rates affect inflation. Before moving on, subscribe to the channel and smash that like button. Now, without wasting much time, let's get started. If you have some financial knowledge or you watch our videos regularly, then you know that inflation is defined as a general increase in the price of goods and services, as well as a decrease in people's purchasing power. This means that when inflation grows without equal growth in your income, you are able to buy fewer items than before, or you must pay more money for the same items now. What is the role of interest rates in the economy? Interest rates are critical to a country's economic development because they influence stock prices and other investment decisions. Inflation and interest rates tend to move in the same direction because interest rates are the primary tool used by the Federal Reserve, the U.S. central bank, to manage inflation. The Federal Reserve Act requires the Fed to foster maximum employment and price stability. Since 2012, the Federal Reserve has set an annual inflation target of 2% to meet the stable prices component of its dual mandate. Because a protracted decrease in prices, known as deflation, can be much more damaging to the economy, the Fed seeks a positive rate of inflation, defined as a sustained rise in overall price level for goods and services. The positive level of inflation and interest rates also allows the central bank to respond to an economic slowdown by lowering rates. The Federal Reserve will implement average inflation targeting in August 2020. That framework obliged Fed policymakers to keep inflation over 2% for a period of time to compensate for periods when inflation fell short of that target. How interest rate changes affect inflation. When the Federal Reserve raises its benchmark federal funds rate in response to elevated inflation risks, it effectively increases the stock of risk-free reserves in the financial system, restricting the money supply available for the purchase of riskier assets. When a central bank lowers its target interest rate, it effectively expands the money supply available to buy risk assets. Rising interest rates discourage consumer and company expenditure by increasing borrowing costs, particularly on regularly funded large-ticket items such as houses and capital equipment. Rising interest rates also have a negative impact on asset prices, offsetting the wealth effect and making banks more cautious in lending decisions. Finally, higher interest rates indicate that the central bank will continue to tighten monetary policy, dampening inflation expectations even further. Inflation and the federal funds rate. During its November 2022 meeting, the Federal Reserve lifted the target range for the federal funds rate by 75 basis points to 3.75% to 4%. It's the sixth consecutive rate increase and the fourth in a succession of three-quarter-point increases, increasing borrowing prices to a new high since 2008. The decision was made in accordance with market expectations. Policymakers also stated that continued increases in the target range will be appropriate and that when determining the size of future increases, they'll consider the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The message could indicate a lesser rate hike in the December, but Chair Powell also stated during the news conference that the ultimate level of interest rates will be higher than previously anticipated. The Fed's goal is to achieve a monetary policy stance that is sufficiently restrictive to reduce inflation to 2%, which is still elevated above 40-year highs. What makes inflation difficult to control? Our central bankers assure us that today's inflation is only temporary. It will vanish on its own. But what if that doesn't work? They claim that central banks will have the means to combat inflation, but what exactly are these tools? Are central banks willing to employ them, and will governments allow them to? If inflation continues to rise, central banks' main tool will be to raise interest rates sharply and maintain them there for several years, even if this generates a painful recession, as it did in the United States, the United Kingdom, and much of Europe in the early 1980s. How much pain and how deep a dip is required to stop inflation and keep inflation under control? The well-known Taylor rule suggests that interest rates climb 1.5 times as fast as inflation. As a result, if inflation climbs from 2% to 5%, interest rates should rise by 4.5 percentage points. When the inflation objective is set at 2% and the long-run real interest rate is set at 1%, the rule proposes a central bank rate of 7.5%. If inflation continues to rise before central banks intervene, containing it may necessitate the 15% interest rates of the early 1980s. Would central banks do something like that? If they did, would high interest rates be able to keep inflation under control in today's economy? There are numerous reasons to be concerned. The looming shadow of debt. Debt casts a long shadow over monetary policy. In 1980, when Federal Reserve Chairman Paul Volcker began raising interest rates to combat inflation, the public debt in the United States was approximately 25% of GDP. It's now 100% of the GDP, and rapidly increasing with no end in sight. When the Fed raises interest rates by 1 percentage point, the interest costs on debt rise by 1 percentage point, and at 100% debt to GDP, 1% of GDP equals around $227 billion. A 7.5% interest rate results in interest costs equal to 7.5% of GDP, or $1.7 trillion. Where are those trillions of dollars going to come from? Congress may substantially reduce expenditure or raise tax collections. Alternatively, the U.S. Treasury could try to borrow more trillions of dollars. However, in order for that option to work, bond buyers must be convinced that a future Congress will cut or increase tax collections by the same billions of dollars, plus interest. Even though investors appear to be confident right now, we cannot assume that they'll remain so indefinitely, especially if fresh borrowing merely serves to pay greater interest on existing debt. Even in the United States, bond investors see the end coming and demand even higher interest rates as a risk premium, rising debt costs even more in a spiral that leads to a debt crisis or a dramatic and uncontrollable increase in inflation. If the US government could borrow any amount and never have to worry about payback, it could send its citizens payments in perpetuity, and no one would have to work or pay taxes. Unfortunately, we do not live in such a fantastical universe. To summarize, higher interest rates must be accompanied by credible and sustained fiscal tightening now or later. Higher interest rates will eventually fail to restrain inflation if fiscal tightening does not occur. This is a totally reasonable idea, yet it's frequently neglected when discussing the United States and Europe. It's embodied in the models employed by the Federal Reserve of the United States and other central banks. For decades, it was conventional international monetary fund guidance. Empowering the small players. Monetary and fiscal change, as well as microeconomic reform, are virtually always required for successful inflation and currency stabilization. Instead of drastically higher and growth-reducing marginal tax rates, the role of fiscal and microeconomic reform is to create sustainably higher tax collections by stimulating economic growth and extending the tax base. Many attempts at monetary stability have failed due to the failure of fiscal or microeconomic reforms. Such instances can be seen throughout Latin American economic history. Even the 1980s experience in the United States fits this trend. The high interest rates in the early 1980s increased the interest expenses on the U.S. national debt, accounting for the majority of the Reagan deficits that appeared substantial at the time. The United States implemented a series of significant tax and microeconomic policy changes, most notably the 1982 and 1986 tax reforms, which sharply reduced marginal rates, as well as market-oriented regulatory reforms beginning with the Carter-era deregulation of trucking, air transport, and finance. The United States enjoyed a 2-decade economic boom, increased GDP, increased tax receipts, allowing debt repayment despite high real interest rates. By the late 1990s, economists were legitimately concerned about how financial markets would function if all U.S. Treasury debt had been paid off. The boom was arguably caused by these monetary, fiscal, and microeconomic reforms, but we don't need to debate the source and impact of this history. Even if the economic boom that resulted in the budgetary surpluses coincided with tax and regulatory reform, the fact remains that the U.S. government successfully paid off its debt, even debt incurred during the early 1980s high interest rates. Inflation would have reappeared if it had not done so. In 2019, the Fed announced a policy of targeting the federal funds rate along with 2 other rates that it sets explicitly. The Fed pays interest on reserve balances to banks for overnight deposits in Fed accounts. It effectively lowers the federal funds rate. Overnight reverse purchase agreements are a supplementary mechanism that pays non-bank money market participants a slightly reduced interest rate for overnight deposits. The Federal Reserve abolished reserve requirements for banks and other depository institutions in 2020. Interest rates and inflation tend to move in the same direction, but with lags because policymakers need data to forecast future inflation trends, and interest rates rates take time to fully impact the economy. Higher rates may be required to manage growing inflation, but slowing economic development often decreases inflation and may drive rate reduction. The Fed sets the rate it pays on banking reserve accounts to target a range of the federal funds rate. It's a balance that can't always be perfect, and the Fed always has to put weight on the weaker side with the help of interest rates. That's it for the video, guys. Hope this video provided great info. Press that like button if it did. Comment down what reforms you want to see in your country's economy. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.